So, guys, welcome to another episode of Slow Life Trading. I got a good subject for you guys today. Today was an early day in the market, so I got something to talk about. What I want to do today is explain why I like the S&P 500 and why I think they're so solid to invest in as an investment vehicle. Whether you're trading it or just investing in it, but right now, what I'm going to talk about is just the pure aspect of just investing in it and investing in it over a mutual fund or an individual stock. Okay, let's get to it. Okay, first of all, you got to realize that I'm somewhat of a lazy stock market trader or stock market investor, especially stock market investor. Okay, now the really lazy one, they give their money to somebody else and let them do it. I'm strongly against that. Okay. In a 401k, you can't help it. But if you don't have a 401k, or if they're not matching your 401k, then you can go ahead and do it. But put you some money somewhere else too. And I would say put you some money in another investment vehicle other than your 401k anyway. You want to learn how to manage your money. Okay. So here's why the the S&P 500 in this particular case, the RSP. Well, it could be the RSP or the SPX or the SPY. Okay, but not the SPX because you can't buy it. Okay, here's why. Number one, if you manage your own money in the S&P 500, we're gonna talk about the SPY or the RPS. Really, the RPS. Okay, because that's what I really like for long-term investment. You don't pay a mutual fund manager a fee. Now, their fee may not be considered much when you just think about it, but it depends on how much money you have with them managing. Because if they're taking, and they charge anywhere from maybe 0.3% all the way up to 2%, okay? If they're taking 2% of your money, which don't sound like much when you just say 2%, but if you got 200,000 and they taking 2% of that, and keep in mind they don't take 2% of the profit, they take 2% of the money that they're managing for you. So every year, so 2% of $100,000 would be $2,000, right? Yeah, every year, whether you lose money or make money. Okay. It may be okay if they produce, if you make 15% that year and they take 2%, you make 13. You can tolerate that. But what if you lose 3% and then they take 2%? Now you lost 5%. Okay. Now I realize I'm only talking about the high side of it. Okay. Of what they charge. All of them don't charge that. And some of them really do a good job because they're managing your money. But do you know what they compare themselves to, or what the measuring stick is that they use to see if they're done good or bad? You ready for this? The S&P 500. So if the S&P 500 lost you 10% that year and they only lost you 5% that year, they think they done well. I'm going to tell you something. If they lose money for you any year, they shouldn't get paid. But they get paid regardless. Even if they don't even beat the S&P 500, they still going to get paid. But here's why the S&P 500 is such a solid vehicle. Number one is 500 different companies inside this one basket that you trade as one stock. Okay, 500 companies. Now that may not be good if it was Joe Blow's lawn service or this other guy's beauty salon or this other person's bakery, this other person here tax services, you know. But it ain't those companies. It's 500 of some of the largest companies in the United States. Okay, 500 of them. And now here's the best part of all. If for some reason, and they have these standards that these 500 companies have to meet, you know, how much profit they make in, the value of the company, all that. Okay. ExxonMobil used to be in the Dow. And I don't know if they kicked out the S&P 500 or not yet, but it used to be in the Dow because ExxonMobil was the largest company in the world at one point. Okay. But when it started losing and slipping, they put it out of the Dow and put another stock in. Well, they do that same thing to the S&P 500. If you get to the point where your company is not producing like it was or used to or should be up to that standard that they set, then they will boot your company out of the S&P 500 and put another one in. It almost, and I hate to say this because nothing is guaranteed, but it almost guarantee that the S&P 500 is going to always be solid. It don't guarantee that it's always going to be profitable and make and grow, but it does guarantee that it's going to be solid. Okay. Now, a lot of these companies in the S&P 500 pay a dividend. Some of them pay upward of 6 or 7%. Some of them don't pay nothing. Okay. But you got 500 companies. So even if you just bought the stock and didn't do nothing else, you would make money from the growth and from the dividend. Okay. You may have seen another video that I done about dollar cost averaging. When I did that for 12 months, it ended up being a break even from where you bought it at to where it is today. You didn't make no money, you didn't lose no money. But technically, you would have made some money because the dividends that each company pay, okay, you could have used that. I mean, that money would have grown in itself because you're getting that every quarter, okay? And they all don't pay on the same clock quarter. Some of them pay in different months. So you're probably going to be getting some kind of dividend every month. Some people use the dividend as their income. That's how fat they in nest egg is, okay? But even if you just in the beginning, you only got one share of the RSP, you still gonna get the dividend from it. So that's a bonus right there. Or the SPY, depending on which one you like. RSP, like I said, is equally weighted, and the SPY is not equally weighted. They're both good. I just like the RSP because the price is cheaper and they're equally weighted. Now, if you wanted to do something like, and this is a little bit more advanced, sell puts and write calls, then, and you wanted to do it more on a weekly basis or something like that, you would probably do the SPY because the RSP only has monthly options. And that's enough. Okay, you don't need no more than that with an investment vehicle like this thing is. It's not as heavily traded, but you don't care. It is solid. That's the main thing you want. And I'm telling you, because you got 500 companies, because they have a standard that these companies have to meet, and if they lose that status, they're gonna put another company in with those standards to replace it. It's gonna make it where the S&P long term, it's gonna have a long-term upward trajectory. Will it have years where it's down? Of course it will. It had that last year in 2020. It was down. But if you're in this for the long haul and you bought these shares last year, especially on the real dips, you're gonna benefit from that long term. Anyway, guys, I just wanted to explain to you why I really do like the S&P 500 over a mutual fund. A mutual fund, guys are buying stocks, selling them, and you know, they're managing and charging a fee. I didn't tell you about an individual stock. And an individual stock, this is really why I like it over that. Because at any given time, an individual stock can tank. And it may come back. It could be a solid company. It can tank. But it may take years for it to come back. And then you don't know if it will. You believe it will. Microsoft, Apple, Google, Facebook, they all had very bad years last year. Okay? And if you was dollar cost averaging, you could have started getting them really, really cheap, and you probably got to benefit from that down the road. But guess what? Those stocks are also in the RSP. So you still own them. You just don't have just that one. And then you don't have to worry about having a basket of stocks or, a stock list to keep up with, like your 10 companies and which ones you're going to buy this month. You just keep buying the RSP every month, okay? And dollar cost averaging would take care of itself. And then when you learn how to do a collar on it, oh my goodness, it can really explode. But anyway, guys, I just wanted to explain, why I like the S&P 500 so much. And I hope this video was something that kind of served you well and helped you out, helped with your understanding. Anyway, until the next time, peace out and keep it slow.